Hello and welcome to today's lesson. I'm your hard-working but indefatigable teacher, Mr. Burton. You will need to watch this video and take notes as you go. You may need to watch certain parts of the video a few times to ensure complete understanding. This is your homework and I will check your notes tomorrow before we get started. I hope you learned something.
Okay, hello and welcome to today's lesson. Today we start our first installment in the general ledger, and today it's all about posting transactions. The general ledger, I hear you ask, what is it? Well, it's the main set of accounts. The main ledger is called the general ledger, and any ledger account is where we record increases or decreases to an item. Every ledger account has a title, two sides. There's a place to record the date and there is a place to record the cross-reference. Remember, it's all about double entry accounting, so every entry is going to have a cross-reference or another account. The T ledger is our main form of ledger to start with. The T ledger has two sides, and this is the ledger, right? It's an account where we record increases or decreases to a single item. Left hand is debit, right hand is credit. And let's apply the T ledger to analyze some transactions. Okay, our T account. Initially, each transaction we need to first analyze it into a debit or credit. And so far, I think we've got this. We've practiced this and practiced this and practiced this. Every transaction should be, you should now be able to debit or credit it. We have done this using a transaction analysis chart. Now we're going to use a journal. In the future we're going to be using a journal. Now the rules for double entry accounting. We know the expanded accounting equation. A plus E plus D equals L plus I plus C. You all know that now. You can write it down and from memory, which is great. Each of these different letters represents a financial element. Debit on the left, credit on the right. Debit and credit being the normal nature of these financial elements. Okay, we increase debit. If an element on the left hand side increases, we debit. Flip it over, the opposite. If it decreases, then we're going to credit it. A normal nature, credit. If it's increasing, that becomes credit. And we flip it over. On the left hand side, if that's decreasing, then it becomes a credit. I hope you're listening to the video and not just taking notes with the sound off here. It's important. Okay, posting to the ledger. Right, really important that you record one transaction at a time. Don't try and do multiple transactions. First comes the debit, second the credit. Debit first, credit second. Once you've decided which side to enter the transaction, the debit or credit, the following details are going to be written. The date of the transaction, the name of the other account in the transaction. Remember, we've always been specifying two accounts for each transaction. Now the other account becomes a cross-reference. And of course the amount, the all-important amount of the transaction. The analysis chart, expanded accounting equation. Very, very, very handy to write that across the top. Okay, so the analysis chart, we know how to do this now. The entry to record is debit, bank, credit, capital. Debit, bank, credit, capital. Debit going first, credit going second. Right, debit, bank, credit, capital. Debit bank means that's to the left hand side of the bank account. So we go to the ledger called bank, the bank account, and write the entry with the date 5,000. Credit capital means goes to the right, credit to the right, go to the right hand side of the capital account and write the entry January 1st, same date, bank. So bank, the cross reference is capital, capital, the cross reference is bank, and the amount, of course. Simple, logical, step by step. Selling goods for cash, two types of accounts. We have the bank. Bank's an asset, it's increasing, so the normal nature must be a debit. Sales, income, increasing, credit. So the entry to record is debit, bank, credit, sales. Our two accounts, we'll start with the first one. The debit account, we're going to start with bank. Debit bank means got the left hand side of the bank account and write the entry sales. Sales being the cross reference of the other account. And the amount. So just pause and think what the other account is going to be, the one associated with sales. Right, let's plug it in. Credit sales means go to the right hand side of the sales account, create a sales account, and on the right hand side, credit side, we credit the bank, the cross reference, the other account, and the amount. Right, balances in the general ledger. Okay, AED on the left hand side, assets, expenses and drawings, positive, negative, positive, negative, positive, negative. On the other side, the LIC, liabilities, equity and contribution side, liabilities, equity and income, sorry, it flips over. So on the left hand side we have negative, on the right hand side we have positive. Like the asset accounts, expense and drawings accounts on the left hand side of the accounting equation, they have the debit nature. Increasing these accounts requires a debit entry. Decreasing them requires a credit entry. On the other side, income accounts, for example, on the right hand side of the accounting equation, like the liability and equity accounts, it has a credit nature. Therefore, they must be increased by a credit entry and will therefore be decreased by a debit entry. Right, recording balances. Let's have a look here. We've got a left hand side, we've got a right hand side corresponding to that accounting equation. Bank, an asset on the left hand side. So the bank, we can see there, has a balance of $9,000. That balance goes on the left hand side. A Accounts payable has a $19,000 balance at the start of the month. Credit on the right hand side, normal nature. Accounts receivable, another asset, balance left hand side, the debit side. A loan, a liability, it's on the right hand side. There's a balance of 30,000. That balance is on the credit side. Okay, recording some balances here. Those balances are coming from the information on the previous side. Stock is an asset, normal nature debit. Capital, that's equity, normal nature credit. Right hand side. Shop fittings are an asset, normal nature debit. Van, of course, is an asset, normal nature debit. Left hand side there, on that left hand side.